Hi, I'm Jim and I was retired. Hold on for dear life. Market moves in recent weeks have been volatile to say the least. How has your portfolio been holding up? In this week's video, I'll discuss three good and three bad market moves for DIY retirees. Stay tuned. Now, it looks like Wall Street has been playing a big April Fool's joke on us all. During the first 8 days of April 2025, my investment portfolio was down sharply, 6.5%. Then it recovered 5.9% on April 9, and then it settled flat to up since then. Now, my experience is probably not that much different from yours or the market at large. In the lower half of this screen, I'm showing the Dow Jones Industrial Average over the same early April period. Now, the tariff turmoil led many to worry about what to do with your 401k right now. The media were rushing out stories about what to do. Shouts of just don't stand there, do something echoed everywhere. Well, as is often the case, the right decision is just don't do something, stand there. Now, a lot of the financial press is really meant to convince the DIY investor that you can't handle it. You need expert advice. And I'm here to tell you that I've been through the great financial crisis. I've been through an early retirement that began when I was 59. I've been through COVID and its little slump and all of the rest, and I'm into 9 years of a DIY retirement, and I'm doing fine. Now, the Babylon Bee had this helpful list of facts to keep you at ease as you watch the stock market plunge. Number one was you now have less money to worry about losing. Less money, less problems. And number six on this was hold the chart upside down. The numbers don't look so bad. Again, it's all about perspective, and I'm going to come back to that, but not exactly their approach. Ben Carlson of A Wealth of Common Sense noted this week that to expect volatility, and the funny thing about investing in a volatile market is that every day somebody declares victory. The markets are up, the downturn is over. Markets are down, we're going even lower. And the result is everyone looks and feels like an idiot depending upon the day. Hey, before I go any further, will you please take a moment to like and subscribe to this channel if you like entertaining ideas from one DIY retiree to another. I don't sell courses. I don't manage people's money. I'm just sharing what I've learned in my DIY retirements to benefit you. I'm sure we're going to see more double-digit corrections in the months ahead. We're not done yet. It recovered a little bit. It's likely to go down again. So I'm going to review three good moves that you could make the next time this happens. Here are three smart strategies for navigating the market fluctuations the next time. First, stay the course. If you've got a solid, well-tested retirement plan, keep calm and carry on. Now, I've ensured I have enough cash and equivalents to cover expenses for the next 3 years, with some in the bank and the rest in tax-deferred accounts. And looking ahead, I have another 5 years of expenses invested in intermediate treasuries and income-producing assets in bucket two. So a 10% dip in equity in assets in bucket three doesn't faze me. Next, keep your long-term perspective in mind. The media loves to sensationalize every short-term market move. But here's a tip. If your investing graph looks daunting, reset the scale to 0. Here's how that looks in Quicken for Mac with my own portfolio. And that certainly does change the perspective. Also, review your long-term asset allocation against your target, not against where the market is right now. Now, we ended 2024 with a 60-40 split, and we're aiming to shift towards 70-30 as we complete our first decade of retirement, and in a year and a half, I'll be filing for Social Security. Now, we're currently at about 56 equity and 44 bonds because of some market moves and some influxes. So I am ready to use these market corrections to invest more. Finally, consider using market downturns for Roth conversions. Now, many of you are likely exploring this option. Now, I asked this question on my community page. If the market falls another 10%, what are your plans? And nearly half of the respondents said that they would calculate how much of a Roth conversion they can make. Only 7% said they would cash out. Many of those that said other, the comments were more about investing money in the market. Now, many of you are exploring this Roth conversion option during the corrections. And while I'm not there yet, another major dip may change that for me. I prefer to do Roth conversions at year end when I know what my expected adjusted gross income is going to be, and I can size the conversions to fit to the top of the current tax bracket. Now, I've been targeting to stay in the 12% bracket for the last several years, but this year we might go to the top of the 22% bracket for Roth conversions. A recent viewer asked about Roth conversions and how much you should do if you think you're stuck already at that 22% tax bracket for most of your retirement. And with his permission, I asked Grok about this and shared the results. And then I asked, could I share his story with others? And he said, don't use my name, but sure. Here's how I posted the question to Grok. This guy, by the way, is very close to my age. And he writes, I have two small pensions from employers, money in IRAs and Roth plans, and some real estate investments. Sometimes I do not see the reason to have any pre-tax IRA money going forward. We have bank funds that are to last us until I take Social Security at age 70, and he's 68 and a half now. I'm trying to figure out if converting more IRA money to Roth money makes sense. I am trying to figure out if it makes any sense to have any IRA money when I expect to be in the 22% tax bracket for the rest of my life. My wife comes from a long-lived family, 95 plus for those that did not smoke, and I expect her to live another 30 years. I probably have 15 to 18 years left. The widow tax situation scares me somewhat. Grok summarized the case. Your friend's situation involves several financial planning considerations, and I'll break this down to help clarify whether converting more IRA money to a Roth IRA makes sense for him. This is a complex decision that depends on tax brackets, income sources, estate planning goals, and the so-called widow's penalty. Let's explore the key factors step by step. Age and income. He's 68 and a half, retired at 67, and plans to delay Social Security till 70. His wife is likely around the same age or younger with a life expectancy of 95 plus. That's another 30 years. The assets, and review the assets. The tax bracket expects to stay in the 22% tax bracket. So for 2025, this is roughly $94,301 to $201,050 for a married filing jointly, assuming standard deductions. He is concerned about the value of having some pre-tax IRA funds left and worried about the widow's tax situation when one spouse passes away. And Grok went on to do some pros and cons, but summed up his case this way. Does it make sense to convert? Let's think about it. The tax bracket comparisons. He's not going to have like a lower tax bracket now than in the future. He expects to stay at about 22% tax bracket for the rest of his life. At 70, Social Security is likely to keep him there, but it could push him into the 24% tax bracket as inflation creeps up. As a widow, his wife would face a 24 to 32% tax bracket. Again, this is just assuming the current tax brackets. If he converts now at 22%, he avoids a future 24% or 32% hit, and that's a win for him and his widow when he's gone. The time horizons, The amount to convert, here's the key phrase. He doesn't need to convert all IRA funds. A partial conversion to stay within the 22% tax bracket ceiling could balance upfront costs with future benefits. Grok went on to suggest run the numbers, use a tax calculator, or talk to a financial planner to model out the tax costs of conversion now and future taxes on RMDs, and also compare his income at 73, when the Social Security will be added to the pensions plus the RMDs, versus her income as a widow. Then check your cash flow to make sure you have the bank funds to cover the taxes, to pay taxes on the Roth conversion without straining the lifestyle before you take Social Security. And then consider the legacy. Grok sums it up with this take, where it says my take, that's really Grok's take. Converting some IRA to Roth likely makes sense, especially given his wife's longevity and the widow's penalty risk. Paying 22% now to lock in tax-free income for her 30 plus years could outweigh keeping all of the pre-tax funds. But it's not an all or nothing. Partial conversions over the next couple years before RMDs could be the sweet spot. He should consult a tax pro or planner with his exact figures, as this hinge on specifics like the IRA size and pension amounts. So I came back with a little bit more detail. I was having an email exchange with the viewer, sharing what Grok had shared. Suppose my friend had about $350,000 left in the IRAs. Is there any reason to keep any IRAs by the time you reach RMD age, or would converting it all make sense? And Grok went in to dig into those facts to see if it makes sense, again, summarizing all the key assumptions, and then came to this conclusion: middle ground, partial conversions. He doesn't have to choose all or nothing. Converting 70,000 a year for 5 years up to the RMD age, for instance, would allow him to stay within the 22% tax bracket. And Grok came back and suggested leave 50 to 100,000 in an IRA. The small RMDs may not matter that much. And Grok's take again was, with 350,000, converting most or all of the Roth over the next few years looks smart, especially with his wife's 30-year runway and the wife's penalty risk. Spreading it out over a few years keeps taxes manageable at 22% and avoids a cash flow crunch. Keeping a small chunk of the IRA left could be a safety net, but the bulk of the Roth aligns with his long-term worries. He should double check with a tax pro to nail down pension, real estate income, and bank fund levels. Partial conversions would be my choice too. You definitely don't want to do it all in one fell swoop, because you're liable to go into a different tax bracket and trip over the IRMA thresholds and pay more for Medicare. In my case, tax deferred balances are too large, and I'm not going to be able to convert all before my RMD ages. I'll be content to reduce the RMDs by that level, and I'm staying within my tax brackets and staying below IRMA thresholds. Now let me cover 3 bad market moves to avoid in these market corrections. First, let's talk about that urge to sell. You might want to cash out your equity investments, but that only locks in a paper loss. Selling when you're in a taxable account could also lead to unexpected tax consequences. By staying the course, you avoid the pitfalls of panic selling. Historical data shows that markets tend to recover over time, and retirees who maintain diversification often fare better during downturns. Next, you might be tempted to surrender. Giving up on the DIY approach and handing over your portfolio to a professional might seem like a solution. However, it would mean paying 1% asset under management fee, which is not a wise choice. Alternatively, some people might be tempted to pull it out of the market and invest in an annuity. And that might seem appealing, but an annuity is just another way of packaging fees in a different structure with complex rules. Finally, you might be tempted or required to splurge. In my bucket strategy, I've allocated 3 years in cash and 5 years in income producing assets for steady withdrawals. A sudden splurge might force me to dip into equities when prices were down if the downturn continues. Retirees often underestimate the rapid impact of unplanned expenses, which can average $20,000 to $30,000 for emergencies, for instance. Now, I built that into what I figure I need for each year's expenses, but sometimes those expenses come up, and that requires you to scramble for the money. You might be tempted to pull money out of the marketplace when prices are down, and that would only undermine your financial cushion and risk the sequence of returns damage. I will conclude with my standard warning. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.